This is Matthew Cratter from Trader University, and today I want to talk about how stocks or how the entire stock market can fall 90%. If you're interested in learning how the stock market actually works so you can make money in both bull and bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So yesterday we discussed the problems inherent in passive index investing in index funds of the kind that Jack Bogle first really introduced to the markets. If you want to get more background on that, I'll link to this video. And today's video will make more sense if you've already seen this one. But I want to talk about what can cause a stock to fall this much. And the main thing that can do it is a lot of manipulation. So we're going to talk about General Electric to begin with. General Electric is currently trading at levels that it first saw in, call it, 1992, early 1993. So this has been a disastrous stock that's unfortunately held by a lot of retirees. I remember in 2000, right as it was peaking, so many people saying, and you'd go to a coffee shop in Palo Alto and you'd hear people saying this, that all you need to do is buy General Electric, put it away for the rest of your life, and you'd retire rich. Now, they were obviously investing using the rear view mirror because the stock had gone from, call it 4 to about 58 in just under 10 years. And so they were investing using the rear view mirror, which doesn't work well. The other really weird thing about General Electric is it was considered extremely well run by Jack Welch. And they would always, if you watched CNBC back then, you watched the earnings report, you would always see General Electric beating their estimates by 1 penny every single quarter for year after year after year. And it was just the most bizarre thing. People didn't seem to have a problem with it. Everyone thought Jack Welch was the greatest CEO of all time, when in fact he was a very terrible CEO. He was very cruel to employees. He put them under a lot of pressure to do what has been alleged accounting manipulation. And this is the only way a company can consistently do this sort of thing. He was followed by Jeffrey Immelt, who was no better. And what was really driving General Electric's earnings was not their light bulbs or anything like that, but was really GE Capital, which was sort of their financial services division. They got into a lot of trouble during the Great Financial Crisis, and they were eventually sold off in 2015. And since then, the stock has really done nothing. But this was an example of a company that really morphed into a finance company. They used a lot of leverage. They used a lot of accounting practices that were quite questionable. And so as a result, you can fool the stock market for a short period of time. You can even fool it for years. But as a result, this is a stock that has fallen about 90% from its highs. In the meantime, you did get paid a dividend, but this has still been a disastrous investment. So you should be suspicious of companies that are too good to be true. Just like Enron was the same way. They always beat their earnings by a fixed amount. They grew very quickly. They grew in a very stable manner. And they were sort of a black box when it came to their accounting. No one on Wall Street really understood how they worked, and everyone was afraid to say that the emperor had no clothes. And GE was very similar because Jack Welch was a very powerful guy. But really, he received a severance payment of $417 million when he left, and the company imploded for the following 20 years as people had to sort of unwind what he had built up. So very disastrous. And this was a guy who was going around to business schools giving lectures about special management techniques. So kind of a empty suit in my opinion. So this would be one example. You got to be very careful with companies. You got to understand how they actually make money. And very complicated financial companies usually end up in a quite bad situation. Enron was sort of a finance company. They were trading. They marketed themselves as an energy company, but they were trading very complicated derivatives, and they ended up obviously committing accounting fraud and going to zero as well. So that's the first example of the kind of stocks that can go down 90% or go to zero. The second example really comes out of what I talked about in yesterday's video in Mike Green and passive investing. If you look at the interview he did with Grant Williams a couple months back, he cites the German stock market under Hitler as an example of a manipulated stock market. Now, I should back up and say I'm not saying that the U.S. stock market is manipulated in the same way. I'm not saying any U.S. government is a Nazi or anything. This is a historical analogy for what happens when you get a lot of manipulation of stock markets, either by central banks or by central governments. So I think Mike Green does a really good job of talking about this. What happened when Hitler came to power in, I believe he became Bundeskanzler in 1933, they basically passed laws saying that stocks could only trade higher. You could only execute a transaction at a new all-time high price. Now, this is very similar to what has happened really for the last 20 years. There's been a concerted effort, you could really say since the Greenspan years, to make sure the stock market only goes up. And so when Dave Portnoy says stocks only go up, there's a certain truth to this. But this is what Hitler did. He thought it was the stock market was a national symbol. As such, it should only go up. And so he passed laws that you could only transact at a higher price. And so what happens when you pass a law like this and people begin to realize that the stock market really can't go down, you get a lot of future price appreciation gets drawn forward. And you also have very little liquidity because people know that stocks are just going to keep going up, and so they don't want to sell. And this is fine for a while. We can see I'll show you the chart in a minute. Obviously, Hitler lost the war, and when the Western powers decided to sort of reboot Germany, they decided they're going to open back up the stock market, the German stock market, and let it trade freely. And in a single day, this is the amazing thing Mike Green cites, in a single day, the German stock market fell 90%. So it repriced back to where it would have been if it hadn't been manipulated. Mike Green says in this podcast that's similar to what we're setting up today. We're setting up a condition under which there's no liquidity. And he talks about how in March they almost closed the markets. Now let's take a look at the German stock market. Hitler comes to power he obviously had some power before 1933, but he really takes control of the country in 1933, and the stock market really goes straight up. I don't know what this means, worries that Hitler's gone too far within Germany. I don't know this particular history. Obviously, Hitler did go too far in so many different directions, but then the stock market kept going higher. Prices were eventually frozen. Here's the March on Stalingrad. Markets were actually closed in August 1944. I believe that the German stock exchange, the Bourse, had been bombed to smithereens, and they were just trading in the basement at some point. But then markets were actually closed. And then here we can see what happens, how the markets fall 90% when they're opened back up in, call it 1947, 1948. And so this is really the risk. I don't think this is going to happen anytime soon in the U.S., where obviously, again, this analogy with Nazi Germany is a very, very loose analogy. I'm not talking politics here. I'm talking what happens when you have central planning that says it only wants the stock market to go up. It can work for a while, but it can create really big distortions. And that's one of the things that Mike Green believes is happening right now with index funds, where you have these flows of money that just that are always going in, and stocks seem to always go up. If they fall, they recover very quickly because the Fed turns on the money printer, and the inflows from 401ks and IRAs continue. But he compares it to a roach motel, where the cockroach can go in but never check out, simply because when everyone tries to get out at the same time, there's not enough liquidity. All the active mutual fund managers have retired. All the value investors have been forced out of business or retired because they think valuations are too high. And you have a really weird situation where index funds control the entire market. And so they don't carry cash on the sidelines like a traditional mutual fund might have 5% cash. Index funds will try to hold as little cash as possible so they don't deviate from their benchmark, which is the index. And so what happens if you have a lot of sellers, there will just be no liquidity. And you could see a similar sort of plunge. Again, I think this is a few years out. I think we're actually in this phase right now where we're going to see just an unbelievable melt up in stocks. But I think it's very important to keep our eyes on the end game and to try to theorize when this is going to happen, because when that day comes, when everyone rushes for the door, you don't want to time it too closely. You want to be out of the market well before that happens. In one of these recent interviews with Mike Green, he says that he thinks stock markets could go up 20x or 50x. You could really have just a mind-numbing melt up before this happens. And I think that's what's going to happen. That's what official policy is, that the stock market can't go down. In fact, it has to keep going up, in sort of an analogy to what Hitler did, saying that the stock market, it was more symbolic, I think, in the Germany of the 1930s and 40s. Today, everything is levered off the stock market, people's retirement funds, tax receipts, etc. And so there are real economic reasons to manipulate the stock market in the U.S. today. But obviously, this is going to end badly. Everyone knows it's going to end badly. But I think we could still have 5 or 10 years, maybe 20 years. Sometimes these things take longer than you expect. But I think this is an interesting analogy to think about when stock markets go down a lot. The German stock market, I believe, went to zero after World War I. The Russian stock market obviously went to zero with the Bolshevik revolution. And so stock markets are a fairly new and modern phenomenon, and there's nothing that says that they can't go to zero. Stocks are risky. And so you have to always keep this in mind. That being said, I think we still have a huge rally ahead in 2020 and 2021, and I'll be talking more about that in later videos. If you enjoyed this video, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I come out with my next video. And let me know your questions, comments, observations in the comment section below. Thanks a lot for listening, and I'll see you in the next video.